Welcome to 3 Simple Steps to a Profitable Trading by Green Forex Academy. You should pause the section to read disclaimer because trading may not be suitable to all investors. You should understand the risks involved before taking action. In this video, you will learn the 3 simple steps to a profitable trading. Step 1, trend direction. Step 2, position sizing. Step 3, hedging a swing trade. That's all you're going to be learning in this video. Now here we have proof of profit from 3 simple steps to profitable trading. If you can see from this point here, you will see that all these are profit. These are all profit, right? If you watch from the left hand side here, you can see that they are the profit. If you scroll now, I keep scrolling up, scrolling up, scrolling up, scrolling up, scrolling up. It's all profit all the way. Now this is a scalping trade, as you can see in this account. If you know how to trade and if you check it clearly, you will see that this is a scalp strategy here, but using the 3 simple steps to a profitable trading that I am using. Now I'll be showing you, this is a real live chat, I'm showing you here of proof of profit from 3 simple steps to a profitable trading. If you can see clearly, I'll be showing you now. You will see the trades and the profit. You can see this is 3,671 here. If you look at a deposit, 3,000, and now 671 is profit. Now if you check 671 as profit from an account of 3,000, that is 22.3% in a trade that is less than 2 weeks. Now this is to show you that this system works. If you know how to trade the 3 simple steps to a profitable trading, it's really going to improve your trading and take your trading to the next level. Now if you are looking to create a consistent profit from your trading but not sure how to get there, then you have come to the right video. I'm going to show you how to become profitable consistently in just 3 simple steps. Now step 1, trend direction. As a trader, we know that knowing the trend, where the trend is going, it's going to help you to stay in profit, or you will be on the winning side. Now knowing the direction of the trend, it has to do with either the trend going up, or the trend it's on the sideways, or the trend is going down. There's always a saying. Most traders often say, trade with the trend. The trend is your friend. The trend is not your friend. The market trend can only be your friend if you know where the trend direction is headed. Now let's come back to step 1, talking about the trend. Now if we look at this, we will see this is an uptrend, right? An uptrend is a series of high waves in the market. It is better to buy impulse only after a correction. What does this mean? When the trend is on the upside, you are looking to buy only. If you know how to trade, in this video I'm not explaining in details, but I'm giving you the concept on how to trade these 3 simple steps to a profitable trading. Now in an uptrend, this is a correction. Here we have a correction. Here there's another correction. Now we have impulse here. This is impulse and this is impulse. Now the impulse is called the long leg and the correction is called the short legs in trading. So if you have a sideways market in a range market trade valid support and resistance levels. So how do you do that? You need to know how to trade valid support and resistance level. And in my future videos, I'm going to be releasing videos to show you how to take this kind of trades, where to place your stop loss, where to enter, and how to go about your trade. If you are in a downtrend is a series of lower lows waves in the market. It is better to trade the market. It is better to sell impulse only after a correction. Now, this is how you need to trade. Now we have impulse going down, correction going up, impulse going down, correction going up, impulse going down, correction going up. And this correction is what we call the pullbacks. So sometimes traders use the word pullback or retracement or correction. Now you want to be trading impulse and then wait when there's a correction. You trade impulse, which is the long leg. So this is how to trade the trend. You need to know the trend. You need to know where the trend is going. Then you go with the trend. When you identify the trend, you go with the trend. In talking about the trend, you have to look for the trend on a higher time frame. Now, when you identify the trend on a higher time frame, then you go back to a lower time frame to look for your entries. So this is how it works. And like I said, I'll be doing this in my future videos. And then this is how trading works. Now we will be moving straight forward to step 2, where we will be talking about position sizing. Position sizing is one key factor to keep you on the winning side. If you want to be a profitable trader, then you need to know what is called position sizing. Position sizing strategy is all you need to be successful and to become a profitable trader. Position size or trade size is more important than your entry and exit strategy when trading. You can have the best forex strategy in the world, but if your trade size is too big or small, you will either take on too much or little risks from the market. Percentage of capital or percentage per day. Now, there's different ways to trade. You can trade if you're starting out with a small account. Sometimes you want to trade percentage of capital per day, not just per trade, because your account is so small that you can take so much trades in a day. But if you have an adequate account with enough money, you can trade 2, 3, 4, 5 trades a day. It all depends on how much you have in your account. So talking about this, I will go straight to show you how it works. Now, this is an example. Here I'm going to show you of an account that is $5,000 account here as an example. Now, if your risk is 1%, risk is equal to 1% amount of 5,000, you will have $50, right? Now, your stop loss pips. Now, it all depends on you. It all depends on your strategy. You might be using maybe tight stop loss, or maybe you're in a swing trade, or maybe you're scalping. It all depends on your trading plan, your trading strategy. But normally it's always good to have more than enough stop loss, so that even when the market is correcting, is pulling back, the market is retracing, the market is going to have enough space to pull back and still return back to the main trend. That is why I will suggest that when you are trading, make sure that always you have more than enough stop loss. Now, position sizing formula. This is the formula here. Now, when we apply this formula to this $5,000 account, you will see that risk per trade divided by stop loss pips is equal to 0.2. And when we divide the 0.2 divided by 10, it's going to give us our lot size. Now, if we have that lot size divided by 10, we're going to have our original lot size. Why do we divide by 10? Because we are trading in a standard form. And if you check it here, your 1% risk, here we're using 250 pips stop loss. Now, when we say 1% risk is equal to 250 pips stop loss multiplied by 0.2, which is equally 20 cents approximately. Now we have is equal to $50, which is our risk of 1% from this account, $5,000 account. Now you can also use other methods or an online position sizing calculator to do this. So it's not something really difficult, and yes, your trading platform has everything for you. If you can look at this here, you just go there and select your lot size. Then it all depends if you are buying or selling, then you place your trade. Now going back to this point, to the same point, control your risks when trading to minimize drawdown. Now the problem traders are facing is because they don't know how to control their risks. If you know how to control your risks in trading to minimize your drawdown, you will always be in profit. Because when your risk is controlled, you will see that your profit is going to be more than your risk. Right? Here we say 1% stop loss rule, $50, or 1% risk portfolio rule. Looking at this two, the first one here is 1% stop loss rule or 1% risk portfolio rule. Now let me explain. The first one is the kind of trader that wants to risk everything in just one trade. And here we have another trader who split his risks. This is the same $50, split it into two places here. $25 and $25 will give you the same $50. Now, if you risk this $50 in one trade, and that trade go against you and you lose this $50, you're out of the market, you've lost 1%. But if you split your risks into two places, you have $25 in one trade and you have $25 in another trade. Now this is going to give you an opportunity to either win the two trade, win one or lose one. Now, with this kind of concept of risk portfolio rules, splitting your risks, you know, in other words, people say, don't put your eggs in one basket. If you split your risks, then you will see that you will be in a better position to be in profit, because you will have the opportunity to break even or even make more profit. So when you control your risks in trading, you will always minimize your drawdown and maximize your profit. So now we will go over to step 3, where we will talk about hedging. Step 3, hedging a swing trade. Now, what is hedging? You might be thinking, yes, you've been trading before, you don't even know what hedging is. Now, hedging actually is not something really common in trading, because most of the big banks, corporations are the people doing hedging because they are taking position trading. Position trading is kind of trade that you can take for months, years, 2 years, 3 years. It's a position. Swing traders, yes, you can take a swing trade between a day, 2, 3, 5 days, and even going into weeks. Now, the concept behind this is the market never moves in one direction without a pullback or a retracement. The hedging concept for going long and short is for a swing or position traders, trading on the main trend and locking in profits on the pullbacks to minimize drawdowns and leverage profit. This is the concept behind hedging. You want to stay on the main trend, and while you are on the main trend, you want to be locking in profits on the corrections, which is the pullback or retracement. Now, how do you do this? You might be wondering, this is a difficult thing. It's not really difficult. Trading long and short and locking in profits on market corrections to minimize drawdowns and maximize your profit. Now, the concept behind this is you have to know where the trend is going. And when you spot the trend and know where the trend is going, then you want to stay in that trend. For instance, in this example, the trend is an uptrend. So imagine that you are buying, let's say that you are buying from this point. From this point, you are buying, right? So from this point, you buy and you're riding the waves to the upside. Now, what happened if you are buying? Like I said, if you are buying from this point here, riding the waves to the upside, you are in a swing trade, right? Or you are in a position trading. Now, what the big banks and the corporations and people who are trading swing or position traders, what they do, they stay in the main trend using a trading plan and a strategy. And while they are in a longer time, they always trade the corrections to lock in profits, to minimize drawdown, and to maximize profit in the long run. So this is the concept behind hedging. Stay in the long trend, keep trading the long trend, and sell the corrections, which is the pullback, right? Now it's something that you can always do, and that is why the big banks and the corporations, most of the times, they always end up in profit, because they can stay in the longer trend for a long period of time, and they keep locking in profit to minimize their drawdown, even if the trend is against them. Now, this kind of concept is a concept that will help keep you in the winning side. But this is something that you need to learn how to do it correctly. And if you don't have that knowledge, you have to seek from professional traders. You have to keep watching videos. You have to learn to take yourself to that position where you can hedge. And as I keep releasing videos, if you keep following this channel, you will learn exactly what I'm talking about and how to trade hedging in the market. Now, it's not something really difficult. It's something you can do, and anybody can do this. So it's not something that people say, oh, hedging is so. So I will read this again. Trade long and short and locking in profits on market corrections to minimize drawdown and maximize your profit. So now here we have come to the end of this video. 3 simple steps to profitable trading by Green Forex Academy. And I will say this. Thank you for watching this video. Click on the link below this video in the description box to visit Green Forex Academy. If you learned something from this video, please click like, make a comment, and subscribe to this channel to get notification each time I release a new video. Please pay it forward by sharing this video with friends on your social media. Thank you. Don't forget to like, comment, subscribe, and share with others. Thank you.